I expect gold is peaking here around 3,000. Will go down in the next downturn. The biggest factor driving gold will not be its monetary value in the future. It will be India. India is the next big China, and Indians love gold for investment and consumption. It's a small show of wealth for people that aren't that wealthy and are getting more wealthy. I'm telling you, gold is going to go to at least 5,000 in the next decade or two, and God knows what after that.
Gold continues its bull run amid heightened market volatility and escalating global trade tensions. Despite some profit booking at higher levels due to a sharp rise in the US dollar, the yellow metal still closed February with gains, marking its second consecutive month of rallying. Gold prices surged 2.15% last month, reaching $2,858 per ounce, as rising trade tensions and investor uncertainty fueled demand. Gold is up 9% yearly, reinforcing its appeal as a safe haven asset in uncertain markets. However, economist and best-selling author Harry Dent challenges this notion. He references the 2008 financial crisis, highlighting how gold dropped 40% in the second half of the downturn while Treasury bonds emerged as the ultimate haven. Dent argues that gold will likely peak at around $5,000 in the near term and decline in the next economic downturn. He believes that India, not gold's monetary role, will be the primary driver of its future value. India's gold demand improved in the second half of this week, but overall purchases remain below typical levels as prices have retreated from all-time highs. Meanwhile, gold trading activity in China remains sluggish, prompting traders to offer discounts. Indian dealers were offering a $10 to $21 per ounce discount on official domestic prices, including a 6% import duty and a 3% sales tax, compared to last week's discount of $12 to $27 per ounce. Additionally, India's gold imports are set to plummet by 85% in February compared to the previous year, marking their lowest level in 20 years. Dent sees India as the next big China, emphasizing that Indians have a deep-rooted cultural affinity for gold, both as an investment and for consumption. For many in India, gold symbolizes wealth and financial security, particularly for those experiencing rising prosperity. Let's delve into the video to gain further insights. Before we begin, consider subscribing to the channel and hitting the bell icon to stay updated with the latest content.
I expect gold is peaking here around 3,000. Will go down in the next downturn. The biggest factor driving gold will not be its monetary value in the future. It will be India. India is the next big China, and Indians love gold for investment and consumption. It's a small show of wealth for people that aren't that wealthy and are getting more wealthy. I'm telling you, gold is going to go to at least 5,000 in the next decade or two, and God knows what after that. But gold is probably peaking here around 3,000 near term. So if it goes back down maybe 40, 50, 60%, next boom, it will be the best single commodity in the world because India is going to drive this boom, not China. Indians consume 3 to 4 times as much gold per GDP as the Chinese. And even though China is still number 2 in the world, it drove most of the growth since the 1980s, okay? India is going to do that in the next 40 years, and it's going to catapult gold with it. First of all, this is an everything bubble burst, okay? Everything, all financial assets, real estate, stocks, everything, most commodities, okay? Gold is doing what it did into 2008. It is continuing to rise in the early stages of a downturn. It will eventually go down only for a short period of time, as it did in late 2008. So it is one of the safe havens. I'm telling people gold is the best safe haven in the early part of the crash, which means now, if I had a choice between buying the Treasury bonds, which are the ultimate safe haven in a crash, as they were in late 2008, I would hold or buy gold here. It'll do best in the first, maybe say, year of the crash. And then in the last year or so of the crash, it'll be Treasury bonds, because when everything goes bad, gold eventually went down about 40% only in the second half of 2008. So gold and Treasury bonds were the two best safe havens. Gold in the first half, Treasury bonds in the second half. So now in my newsletter, that's why I'm telling people I'm into gold now more. and transitioning into Treasury bonds after we see what we have to see, by the way, Kai, is we have to see a first crash that is 40% or so in this year to say we finally topped and we're going into a longer term downturn for the next 2 to 3 years. Once that happens, gold is still the best safe haven, I'd say, into 2025. As we go to 2026 to 27, then the Treasury bonds, TLT, average 20-year Treasury bonds, 10 and 30, that becomes the best. So those are both. So I would start with gold, maybe 80% gold, 20% TLT, GLD, 20% TLT for the Treasury bond. And I would switch to the opposite, 20% gold, 80% TLT into the second half of the downturn. And of course, I'm going to have to gauge that when it happens. I think this is going to take 2 years minimum, 3 years maximum to shake out.
The total federal debt now stands at $36.2 trillion, amounting to 123% of GDP. For context, at the end of World War II, the debt-to-GDP ratio was only 106%, and that was following a major global conflict. Today, the U.S. faces this mounting debt burden without having been engaged in a large-scale war over the past 5 years. By 2035, the debt ratio is projected to hit 118.5% of GDP as rising interest costs deepen the deficit, forcing even more government borrowing. Looking ahead, net interest payments on the debt are expected to nearly double from 2024 levels, reaching a staggering $1.8 trillion by 2035. Harry Dent believes we are witnessing the peak of the largest financial bubble in history. He argues that central banks and policymakers have prolonged the market cycle through excessive money printing and unsustainable deficit spending. However, rather than solving the underlying economic issues, Dent warns that these interventions have only delayed an inevitable and severe financial crash. Now let's redirect our attention to a video.
We had the biggest natural bubble in history in the late 90s, similar to the Roaring 20s. Those were what I call natural bubbles. The economy's so good between growing demographics and technological progress that, things are good and then stocks get overvalued. Okay. Well, it's different this time. I mean, what happened after the 2008 crash, which Kai, I predicted in the early to mid 80s that the U.S. would predict in this long baby boom driven boom in late 2007 and start to go down for 12 to 15 years after that, way back then. Well, the difference here is this time when it did crash in 2008 and started to go down well into 2009, government stepped up and said, well, wait a minute, we've got new tools that we never knew we had before or never used. It's called printing money. We'll just run endless deficits and we'll print endless money. And it wasn't the Federal Reserve chairman that started this. Mario Draghi in Europe said back when things started going down in 2008, he said, if any investors want to short this market, I will blow you out of the water. I will print so much money, you'll wish you'd never even thought about it. That's the beginning of what we're in now, okay? So we've had this long downturn, which should have been from 2008 to 22. I, again, predicted this all the way back to the early to mid-80s. Baby boom generation peaked in their spending, biggest generation in history. They do it on a 46-year lag to the birth index. Average peak spending in the United States, totally documentable, okay? And we went into this, but they have, between fiscal stimulus of 8 to 9 trillion fiscal stimulus of 16 trillion and 8 trillion plus in monetary, they've just blown us out of this. They just printed enough money and ran enough deficits to make up for the decline of the 70% private sector. So that's what's happened here. And here we are still where markets have gone up because of that. And yet, where do we go from here? How do you stimulate more than that? And things are weakening again here. So I think we have put off what I call a Great Depression between 2008 to 22. We just put it off, so it's going to have to hit the second wave after 2008 to 9 into the next few years. Now, we'll have to see how markets react, but I'm telling you, this is not sustainable. You can't just print money out of thin air. And you cannot run endless deficits without compromising your own credit quality. I mean, people don't realize the U.S. government is the best borrower in the world. We have the lowest rates for borrowing of any entity in the world, which has allowed us to run unprecedented deficits. But you can't run unprecedented deficits without eventually getting into trouble. And I think that's why we're in trouble now. We had this big crash in 2007, 8, 9. It should have gone much lower, but they printed $27 trillion in combined stimulus to offset it. And now we're still, okay, well, we've gotten about back to where we were, and we're still struggling. What happens next? I think this second greatest, longest bubble in history. And I'm just telling you, folks, if you go back and look at stocks long term, if you think the roaring 20s was a big bubble or the mid to late 90s was a big bubble, look at this one since early 2009.
The yellow metal recorded 10 fresh all-time highs in February, signaling heightened investor anxiety and a growing preference for wealth preservation. Historically regarded as the ultimate safe haven asset during economic turmoil, gold remains in focus amid market uncertainty. While India's gold demand improved, it remains weaker than usual, with imports expected to plummet 85% in February to their lowest level in 2 decades. Meanwhile, China continues to expand its gold reserves, underscoring a strategic accumulation trend. At the same time, mounting concerns over the financial system's sustainability persist, as rampant money printing and deficit spending have contributed to what is considered the largest economic bubble in history. Is gold still the best safe haven asset, or do other alternatives emerge in today's financial landscape? Feel free to share your thoughts in the comments. If you found this content helpful, give it a thumbs up and remember to subscribe to stay updated. Thank you for being a part of this journey with us.